Good evening, everyone. Good evening. Glad to have you here with us tonight. We have another series on our financial peace, pathways to peace, and we are here with Mr. Kenneth Royster of First Genesis of Norfolk Financial System. And so I just wanted to introduce you all to him. He is been in business for over 40 years, located in Norfolk, Virginia. He's licensed to do business in many, many states, including North and South Carolina. So we are going to talk about investing tonight. And if you have any financial issues or anything that you need to learn about or want to hear about, Ken is your man. He can talk to you about any and everything from retirement to taxes to investment to money, lifestyle, whatever you need. This is the subject matter expert in all of those fields. So hopefully we can sit back and relax and get our questions together, like and share, and we're going to enjoy listening to what Mr. Royster has for us this afternoon. And if you need to contact him, all of his information will be at the end of the presentation. So don't hesitate to call or locate his office and ask the questions that you need to ask. So without further ado, Mr. Royster, take it away.
Thank you, Reverend Sims. Good evening, everyone. Investing with confidence, risk tolerance, asset allocation, and investment types. I have a question, though. I got to start with a question tonight before I start talking about stuff. How many of you all are investors right now? How many of you? Please put in the chat your name if you're an investor, or yes, I'm an investor, or no, I'm not an investor right now. If you put that into the chat, that'll be excellent. Okay, that way I can get a feel for who I'm talking to and where they are kind of in the scope of things. So I'll give you a minute or so to do that, and let's see where we go from there. In the meantime, you can go ahead and bring up the next slide. Our agenda for tonight, pretty basic. I'm going to talk about risk tolerance. I'm going to talk about asset allocation, and I'm going to talk about investment types. Most people don't understand that these are kind of the essential ingredients to building a wealth portfolio for an individual. What's interesting is that as I go through this presentation tonight, you all will see that it affects people differently. No one's going to have exactly the same thing. And so if you ask a person about investing, it's from their vantage and their positioning according to these three items here: the risk tolerance, asset allocation, investment type, versus you said, I'm with an investment company and I'm making this amount of my money, or I'm with that firm and well, if your allocations are different, you're going to have different results. So there's no quote right or wrong. It's really what fits you as a person. Okay, next slide. Uh-oh. Okay. All right. Risk tolerance, next slide. All right. Risk tolerance is an investor's ability and willingness to endure fluctuations in the value of their investments, including potential losses in the pursuit of long-term financial goals. Let me put a pin on one part of this right away, and that's the fluctuations. The fluctuations is what's expected when you invest. If there was no risk in investing, everyone would do it. There's nobody's going to tell you that if I can make 10% on my money and take no risk, I'm not going to do that. I'm going to do that. That means my money will double every 7 years. I'm going to do that. I want to do that. But the other part of it is the potential losses. Well, fluctuations and potential losses don't go together. Fluctuations happen. Potential losses are mostly created by the investor by selling the investment at the wrong time. Every once in a while, you as an investor may buy a bad investment that just doesn't do well. But 9 times out of 10, it's because the investor's timing is wrong. That means that they're selling out when the investments are down. We call that panic selling. You don't want to be doing panic selling. You want to be doing panic buying. When markets are low, declining, you're buying more shares in the decline than you are when the market's going up. All right, next slide. So you got some elements in this risk tolerance equation. You got your time horizon, your particular goal, your age and the stage of life you're in, and then you have your own personal knowledge and experience. When folks come to us, say, I want to invest, I always ask them, how long are you willing to put money away for? 3 months, 6 months. That is not long-term investing. That is short-term savings. And so if you expect to make a lot of money on your investment, you won't make it in 3 or 6 months. Well, sometimes someone say, well, I had a friend of mine who just invested in crypto and they doubled their money in 90 days. And I said, well, you didn't talk to the person who lost 75% of their money in 90 days who also invested in crypto. It's the timing of the buy and the timing of the sell that gets you your rate of return. And it's over normally extended period of time. Very few people are what we call good traders, where they can stay and trade stocks every day and pick all the winners and get rid of all the losers. Pretty hard to do. And when markets are across the board negative, pretty much there's no place to hide, as they would say. So let's talk about time horizon. Longer horizons allow more time to recover from market downturns. We call those dips. If you look at the market as a whole, you'll see it do like this. It trends up. It trends up, but it will have peaks and valleys during the trend, but it trends up. The market is at an all-time high today. So we know that the stock market has been in existence for over 100 years. So if the trend's been up over all that time, why are people still afraid to invest? I can tell you why. Short-term mindset for long-term investments. That's why. You can't have a short-term mindset and be an investor for the long term, because you'll always do something wrong in the short term that will affect you forever in the long term, versus understanding that it's a long game. Once you've got in the game for a while, then when you get to ready to retirement, then you start maybe shifting to more short-term type of positioning. Investment goals, big 3: retirement, educating your children, and buying a second home. Those are our big 3 that people are willing to invest and save for over their lifetime. Now, some people say, well, what about getting married and buying a car? Those are short-term investments. Now, if you're having some big extravagant wedding, then you might need a long-term investment plan. You don't spend $50,000 getting married. And I've seen it. And normally it's a year, 2-year event, and God bless the parents who pay for it. Those folks better stay together, is what I say. You spend all that money, just get together. Let's see if you can stay together. Investment goals, as I said before, your second home, retirement, sending your kids to college. Those are really the most prevalent ones that we help people plan for. And then you have age and stage of life. Younger investors often tolerate more risk. Older investors may prioritize preservation. Depends. If I'm an older person and I'm well suited with my current income, I can be more aggressive with my investments in retirement with the hope of possibly passing on more greater wealth to the next generation. If I'm not overfunded for my own retirement, then I'm going to be more cautious to make sure that I don't run out of money before I run out of life. Younger investors have nothing but upside. And that's why I tell folks, the younger you start investing, the greater power you're going to have economics. I can make a 30-year-old a millionaire in 35 years just doing $100 a month of investing. And people say, how's that happen? That's the power of compounding, and that's the power of stock price movement. And I'll talk a little bit about that a little bit later. And knowledge and experience. Familiarity with markets can increase confidence in handling risk. Well, unless you are probably in the profession, most people don't study the stock market. They don't study investing at all. They just know it's there. So I'll give you some basic right now that will help you understand. Everything you do in your life is tied to the stock market. You go, what do you mean? Everything I do is tied to the stock market. Are you buying a house? Well, there's an investment company that makes the wood and all the appliances and everything else that goes into the house, and they're publicly traded, and you're participating by buying that house. Do you have electricity? The power companies are also publicly traded. Do you have water? Water companies are publicly traded utilities. Do you buy lawnmowers from Home Depot or Lowe's? They're publicly traded. Do you eat food from any major grocery store? They're publicly traded. You eat food from any fast food national chains? Publicly traded. You drive a car? Big automobile manufacturers, they're publicly traded. So whether you want to participate in the market as an investor or not, you certainly going to participate as a consumer. And that's the change. Why would I be buying all this stuff from other companies and then turn around and not be able to reap any benefit from what I bought? That doesn't make any sense. I should be investing. I should be investing in all the stuff that affects me. Clorox, cereal, gas, everything is publicly traded. So I can participate. I just got to know where to go to participate. And if I don't know where to go, then I'm out. But if I know where to go, I'm in. Okay? All right. Well, good question. In this current market climate, how much? Okay. Mr. Music Nation. Is that music? I can't pronounce it. I'm sorry, sir. But I'll just say this. 5 to 7 year trends. Good time horizon. If you check it out, there's probably maybe in the last 100 years, 1 5 to 7 year period where there was a negative at the outcome of it. So in my lifetime as an advisor, the longest period of decline that we had was from 20 to 22. Okay, 2002, I'm sorry, 2000 to 2002. We've had the economic crisis in 2008. That coupled with those first 3 years, we call that the lost generation, the lost decade from 2000 to 2010. But from 2010 to now, we have been in a bull market for the most part. We've had some ebbs and flows. But let me help you with your question about trust. In investing, it's about activity. So example, there's a lot of fighting going on in this world, wars. Well, you can invest in defense. You can invest in companies that manufacture weapons, like Northrop Grumman and Lockheed Martin, Raytheon, and other companies that build these ships and so forth. Food. You can invest in food, grocery stores, and so forth. Again, over the long term, people got to eat. Healthcare, people got to be taken care of medically. Pharmaceuticals, people got to take drugs. So you can invest in sectors all across. But again, when you're doing it 5 to 7 years, I think that you can trust the market a lot over a 5 to 7 year period. Next slide. Oh, okay. An offline question. If I've doubled my money on a particular stock, would that be a good time to take at least the gain, or when is it a good time to take some gain? Again, that goes back to horizon. What was the purpose of the investment initially? Was it just to see if it could make some money, had no target for retirement, or no target for buying a home, or no target for educating a child, no target? Then certainly taking money off the table is always a good thing. But then what are you going to do with the money that you made? Are you going to spend it? Or are you going to reinvest it in something else? That's really what comes down to, is if I don't need the money, and the potential of the stock is still good for future more growth, I'm going to stay with it. But if it looks like it's come to the end of its run, then I will go ahead and sell it. I certainly would. I'd take the gain then. Okay, you can take that down. All right, so we have what we call the risk tolerance scale. Low risk people versus high risk people. Low risk people tend to be conservative. They want to protect their money. That's what preservation of capital is. And they don't care about what you could make. They say, I just more concerned about the return of my money than return on my money. That's a conservative investment position. A moderate conservative person is still geared towards protecting principal, but says, I'll take a little bit of risk to get a little bit more than better rate. For instance, maybe instead of buying a CD at 2 or 3%, I might buy a fixed index annuity that might pay out 5 or 6. Okay, but I can't lose any money on it. Could go to 0, but I can't lose any money. They might want to do that in lieu of that. Also, they can build a portfolio where it's more heavily weighted towards bonds and cash versus stocks, and we'll get into that a little bit later. Moderate, that's right in the middle, right down the road. Person says, listen, I want to make some money, but I am a little nervous about the market, but I'm willing to take risks anyway because I need to do that to grow my money. That's the majority of investors are moderate. Majority of investors are moderate. Moderately aggressive. Primary goal is long-term returns and willing to accept significant risk. Well, significant is in the eye of the beholder. This person says, listen, I got a 10-year runway. I don't need this money. I want to see how much I can make over the next 10 years. I'm not going to pay attention to up and down. I'm looking for it to be an average, a 7 to 9% rate of return average. If I do that over the next 10 years, my money's going to double. That's what they're after there. The aggressive person says the exact same thing, except for they want their money to double faster. So they're expecting 10 to 15% rates of return over 5-year periods, 6-year periods, which gets them doubling their money in 5 or 6 years. And so they're not worried about the ups and downs. They don't need any of this money that they're investing to live off of. They're not afraid of taking losses in the short term. They're looking at it over the long term. Next slide. Next slide. So when we talk about these asset allocations, all right, a conservative person, as you can see, is going to be 70% in bonds, 20% in stocks, and 20% in cash and 10% in stocks. They're conservative. They don't want to take a lot of risks. So their money is weighted in cash and bonds. I have most clients even more weighted in cash than even the 20%. They might be weighted 50% in cash, cash equivalents. Next slide. So here we got a moderately conservative person. And you can see they're about 55%. Again, as I said, that person might be 50% and still maybe only 5 or 10% in stocks and then the rest in cash. So again, these type of portfolio setups they pretty much are what we call bulletproof against losses, but at the same time, they don't offer a whole lot of upside because they're not positioned for that. Next slide. All right, here we go. Now we got a moderate person where we got 50% in stocks, 40% in bonds, and 10% in cash. This person can win across the board. And the reason why they can win across the board, because bonds and cash equivalents tend to pay income every month. They pay a distribution every month, so it can offset any losses in share price. Give you an example. If I have $1,000 in bonds that's paying 5%, that's $50. If the bond prices were to go down, okay, and it was now worth, the bond was worth less than $1,000, the income would generally go up. Instead of getting $50 a year, I might be getting $60 a year. The key is holding. So let's say we have a 5 or 10 year horizon at $50, okay, on 1,000 over a 10-year period. I'm going to make $500, 50% just on the income. Now, what's the price of the bond at maturity or at the end of the 10-year period? Who knows? But I would have made at least 50% on the money during that time because I didn't sell anything. I just took the distributions. All right. With stocks, it's the same thing. I got the price. The young man said earlier, when the price goes up, do I take money off the table? You could. We're doing every kind of strategy possible now with clients in retirement, where we look at the whole portfolio and we make decisions about where we're going to draw money for retirement. All right, next slide. Moderately aggressive. So now we're moving into a different realm where we're now overweighting in stocks, 65%, 30% to bonds, and 5% to cash. Well, I've seen it even more than 65. I've seen it at 70. Okay, I've seen it at 70, and I've seen cash be about 10 and bonds be 20. Again, as long as you're in that mildly aggressive where there's more invested in stocks than there is anything, then you have that chance of winning with that portfolio. Next slide. And aggressive. You notice no cash. No cash. This person's all in the market. 90% in stocks, 10% in bonds, and that's just a buffer. I've seen as much as 100% all stocks, no bonds at all, because the person is trying to get the maximum return on their money over a set period of time. Again, 5 years or longer. Next slide. So if you say, well, what am I going to invest in, Ken? Whew, a lot of choices. CDs, ETFs, annuities, commodities, businesses, IRA, 401k, 403b, stocks, real estate. Again, one I don't have on that is crypto and crypto as well. So there's a lot of different choices of what I'm going to do with the money. The issue becomes what we talked about earlier about your risk tolerance and your time horizon and what kind of person you are, how you feel about investing. You could have a little bit of everything in a portfolio, but it's still got to fit you at the end. Next slide. So in the stock category, if you look at the caption, you see McDonald's, Google, Yahoo, Coca-Cola, MasterCard, Apple. These are big companies. These are all big companies. And the term they use is market capitalization. That means these companies are worth $10 billion or more. So market cap is the price of a stock times the number of outstanding shares. That means that people own shares in the marketplace, publicly traded. So if you think about a $10 share per share, there has to be $1 billion, a billion shares of that stock in the public market for it to be a $10 billion company. Normally the stock prices are somewhere mid-range, anywhere between 50 to $300. You see some stocks that go up for $500, $600, $700. They're harder to package and buy, but you can buy them in a portfolio of mutual funds or ETFs. Mid-cap stocks are $2 billion up to $10 billion in value. And then small company stocks are $300 million to $2 billion. So when you're publicly trading these companies, these are big companies, got a lot of money. So you should not feel that you're at so much risk investing in them. You pay attention to what they do, okay? Because every once in a while, someone will do something crazy and get some kind of lawsuit against them, and they could be wiped out that way. But for the most part, they're solid operating companies, and you can count on them. Growth stocks, again, these are companies that are expected to grow faster than the overall market, okay? They also reinvest their earnings. That means instead of paying out a dividend, they keep everything in the house and grows the share price, okay? Got higher risk, but a very strong upside potential. Example is Tesla. You know, Tesla fell quite a bit when Elon Musk got involved with the government. As soon as he got back to the company, the stock price started going back up. I don't even have to talk about Apple and Coca-Cola. Okay, this is products that get consumed every day, and they do a great job advertising themselves. So they maintain a good market share, and they have a good product. Apple's a good computer, Coca-Cola's a good soda. So kind of go with that. International stocks. This is shares of companies based outside of the United States. Some of them you know right away: Mercedes-Benz, BMW. Okay. Some of these companies, what other companies? Samsung, back in the day, Sony. These are all international companies that are publicly traded. And so you can invest in international stocks and you can win with them as well. I would tell most people that over the last decade, though, the U.S. stock market has dominated the investment market. We're starting to get some play right now, international stocks coming back. But for 10 years, the U.S. has been the place to be, and I still continue to believe that it's going to be the place to be for investors. Emerging markets. This is companies that have the potential for rapid growth, but they carry a lot of risk. Those emerging markets tend to be Mexico, Indonesia, any small country that is up and coming with stocks. As you see, an example here was Alibaba was a stock that was considered an emerging market, but it's a main player now. Okay, next slide. Then you have bonds. You have 5 segments of bonds. You have corporate bonds. That's bonds that are issued by corporations. They pay a dividend, and they're subject to tax. International government bonds, they come in all the same forms of corporate as well as high yield and treasuries, but they're overseas bonds. High yield or junk bonds, don't let the term fool you. There are some good junk bond funds out here that are paying out 9 and 10% income and have been doing so for 20 or 30 years to investors. Now that income will fluctuate, but on average, it's going to be high. That's why they call it high yield. T-bonds, that's issued by the United States government. They're backed by the full faith of the U.S. government, and therefore you buy them and hold them to maturity, and you'll get your interest payments when they're due. But if you try to sell the bond before its maturity, the price is going to be based on market price. And last but not least is municipal bonds, munis. Again, this is for people who are looking to get income but don't want to pay tax. So they basically take income in the form of distribution from a municipality, and they don't have to declare that for federal income tax. And sometimes even some of the municipal bonds are also exempt from state taxes as well. Next slide. Cash equivalents. Everybody get this one. No problem, right? Physical currency. That's the money in your pocket, under your mattress, in your safe at the house or your safe deposit box at the bank. This is cash money, physical currency, bills and coins. Okay. So cash is cash and it's always going to be that. Treasury bills, T-bills, become very popular over the last 10 years. Short-term government securities, extremely safe and easily to be converted to cash. So these T-bills, again, have lower yields, but every once in a while they'll come out with a nice high yield T-bill, and you can buy those as well to their maturity. Commercial paper. This is mostly done with corporations, not individuals, where it's unsecured short-term debt issued by a corporation, typically used for financing payroll or inventories. So again, this is something that you won't get directly to you as an investor, but it'll be part of a portfolio that you may buy as a cash equivalent in a portfolio. Money markets, everybody's familiar with those. You know, those are pooled investments held for short term, and they provide liquidity and modest returns. You can get the money. Some money markets do make you hold for at least 12 months. All right, next slide. Okay, well, that pretty much covers all of the investments and types. One of the things I will add to the presentation that wasn't in the slides was when you set a goal for your money, it should have a reason that you're doing it. That way you don't faint in the middle of movement. Example, I want to buy a retirement home in another state, and I know the houses cost $300,000 or $400,000 where I'm trying to have my second retirement home. Well, when you're buying your second home, the down payment requirements tend to be higher. So you don't have to have enough money to pay for the house cash, but you got to have that down payment, which is going to be normally 20 to 30%. So if I said earlier, if I have a $300,000 house, I'm going to need $60,000 to $90,000 cash as a down payment on that house to get into it. Well, now let's back into the higher number, $90,000, and let's say my goal is to do this in the next 5 years. I divide 5 years into 90,000. I'm going to end up with that 16. Yeah, 16. I got to invest $16,000 a year minimum, right? If I get zero rate of return, I got to invest $16,000 a year. It's a little bit over $1,000 a month. But what if I anticipated growth of 10% on my money? If I anticipated growth of 10% on my money, now I only have to invest half that amount. I only have to invest half that amount, and the market will make the rest of it for me. And that's where the power of investing really rests, is in this ability to compound itself over time. And I know folks are saying, well, you know, markets are risky. Well, it's more risk not investing. You never get ahead not investing. So you're going to invest in real estate, you're going to invest in the market, you're going to invest in a business, okay? But you got to be an investor to win. Nobody's going to just save enough money to be rich. That's pretty hard to do. And even if you saw a person that they got a lot of savings, they probably got that savings from investing in a business of some sort. Okay. All right. The floor is open for Q&A. Okay. I don't see any questions. I don't hear any questions. All right. Reverend Sims, you want to come up?
Difficulties. I had a little technical difficulties just there. But I had a couple of questions too myself.
All right.
When you are investing in the stock market, is there a particular brokerage firm that you invest in, one that's better than the other?
No. the firms, they're there to do the trading. That's their purpose, is there to do the trading. I would say it's important to have a quality firm, because you want a company that has technology, can get your statements out to you quickly, can execute your trades on demand, and that type of thing. But the person who's more important is the advisor.
Okay.
That's the most important person, is who is that advisor aligned with. So if I have a not a quality advisor and a not quality firm, my results would probably not be that great. If I got a quality advisor and a quality firm that person is representing, I should be fine.
Okay. What about the fees? Is there a particular fee that's pretty average, or because you don't want to have to pay so much when you're investing?
Yeah, the average financial advisor is going to charge a 1% asset management fee. So
Okay.
if you invest $100,000, you'll pay $1,000, but you don't pay that all up front. You pay it on a quarterly basis.
I see.
And you might see this commercial that's out there now from one investment company that says we're a fiduciary. We make money when our clients make money.
Yeah.
Well, most advisors are fiduciaries anyway. Most of them are, and they operate on the same guise. The issue is, what firm do they represent? Do they have the length and breadth of all the products and services that you might need, versus that I have to go to 3-4 people to get my portfolio fulfilled, versus having one person, one firm can do it all.
Got it.
Okay. But 1% is the standard. Some people, when you get to a certain dollar amount, they might reduce the fee, but 1% is generally pretty standard.
Wonderful.
Mm-hmm.
The other thing is, when you're investing in the stock market, there's something called dollar cost average. Can you explain what that is?
Certainly. If somebody has a pencil and piece of paper and want to just follow along, it's real easy. Let's say that you're investing $100 a month. And the first month, the share price is $10 that you're investing in. Then you're going to end up with 10 shares.
Okay.
The next month you invest $100 and the stock price falls to $5. You're going to pick up 20 shares that month. Okay.
Uh-huh.
The third month, let's say that it's $7.50 is the share price. Okay. And you bought $100. Let me do my math real quick here on that one. You're going to come up with $13.3 shares. Okay.
Okay.
So now you add up all your shares, 10 plus 20 plus 13.33. You end up with 43.33 shares. After, right?
So it's a good thing to dollar cost average, whether it's on.
Well, let me show you the end product. So that's 43.33. You invested $300. Right?
Uh-huh.
All right. That next month, the shares are worth $10 again. Now it's $10 times 43. $433.33. You only invested $300.
Wow. Okay.
Okay. Now it can work the other way too. If the shares are only worth $5, right?
Mm-hmm.
So now I only have $216 and some change. So I'm actually negative.
Yeah, yeah.
But I've only been investing for 3 months, right?
Yeah.
Right. I got to give the share price a chance to go up, right?
Yes.
So my dream is for the share price over the next 5 years to go from 5, 10, 7, or 10 to $20 a share.
Mm-hmm.
And if I had $20 a share at $43, I'm at $866 against my $300. I would have doubled my money in 5 years.
Wow. Okay.
That's the power of dollar cost averaging. And as I told everyone earlier, I'm do my hand again. What's the trend with investing? Up.
Increase, up.
Up.
Yeah.
Peaks and valleys in between. I just illustrated that to you when I said price goes 10, 5, 7, 10, and 5. That's
Mm-hmm.
peaks and valleys. But if I let it run out over a long term, it's going to end up normally at that $20 mark 5 or 10 years down the road.
Yeah, that's so good.
Right. So that's why you do it. And that's why you don't faint in the middle. You got to remember, I got a goal. Either it's a time goal or it's a thing goal.
Okay.
Yeah, I want something over a period of time, or I just want to invest for a certain period of time and see what happens. And that's what people should do, is measure to see what happens. Most people who make money will just tell you, I'm just happy. I made money. Okay. I don't know how much, but I know I made a lot.
Yeah.
I didn't put in as much as what I have. All that is what we call 101 basic investor, but at least the investor is staying with the investment long enough to get the fruit of the labor.
Wonderful.
Right. Let your money go to work for you. You don't have to do all the work. Have some faith in the economy that you live in.
Mm-hmm.
Because guess what? You tell me today that you don't go out and spend any money. Right? Whether you like it or not, if you got lights on, you're spending money.
That's right. Yeah.
You got your water in your house, you're spending money.
Yeah. Yeah.
You're driving a car, you got taxes on that car, you got insurance on that car, you're spending money. You are fueling the economy with every single thing that you do. So why not reap some of the benefit back on the backside by being an investor?
Yeah. Yeah.
If you just a saver, you basically are giving away money, because guess what the bank does with your money?
Invest it.
They invest it. Thank you. They promise you they'll give it back to you. Why? Because they got so much of it, they can.
Yeah.
It will take a run on the banks for them to be in trouble. And guess what happens when banks get in trouble? They just lock the door.
Or to get money from the government.
ATM machines and say you can't get your money. It's happened before. It's happened before.
Yeah.
Okay. But if you're an investor, you live in with stock price. So
we should all be taking some kind of risk, right?
Yeah, you're always taking some kind of risk. The risk of doing nothing is just as bad as the risk of doing something.
Yeah. Yeah.
Okay.
That's good stuff.
That's
good.
So
I have one other question. Can somebody make especially a young person, investing in dividend stocks only? Would that be a good portfolio? That way they will be able to get a check, maybe even.
I wouldn't worry about a young person getting no check. That's the first thing. Okay. All right. And that's a more what we call a moderate to moderate aggressive position versus aggressive.
Mm-hmm.
I'd rather a person invest in technology. And even if it's a low dividend paying stock, the growth on technology stocks is unbelievable. If you had NVIDIA or Palantir or Apple, Microsoft, when these companies start up and they start moving forward in technology, you win. Even telecommunications, Verizon, these companies are making money hand over fist selling their services. I tell a person, think about it. If you're a family of 4, you're spending at least $5,000 a year just to have cell phones.
Mm.
You're spending $5,000 a year just to have a cell phone. Now you go into your house and you think about cable TV and internet. You're spending another $2,000 a year there. So most households are spending $7,000 a year at the minimal technology level. God forbid you buy a laptop computer, right?
Yeah.
Right? You buy a laptop. God forbid you buy an Apple Watch.
Mm.
Okay? God forbid you buy an iPad. All of those stuff start adding up. And guess what? Nonstop. It's nonstop. Every time they come out with a new model, what do you say? They tell you, we'll trade your phone for free.
Yeah.
Why? Why would they trade your phone for free? Because the service is where they make the money, not on the phone. Now you got bad credit, they make money on you both ways, on the phone and on the service. But you got good credit, they say, we'll give you the phone. Yeah. We know we got to fight for other companies' business, so we got to give you the phone. Some of them say right now, they give you 4 phones for free for 4 lines of service. Okay.
And people think it's a good deal.
Right. It's a good deal. Right. And the deal's in the eye of the beholder. Right.
Yeah. Yeah.
But on the backside, the company's profiting on that deal.
That's true.
Okay. Now, if I'm going to buy your phone, I'm going to buy some of your stock too. Okay. Right. So if I got my portfolio and my services with Verizon, I want something in my portfolio that got Verizon in it.
Sounds good.
Right? Everybody wants some of MasterCard or Visa, right?
Yes. We use it
so
all
I
the time.
want MasterCard and Visa in my portfolio because I know people using that for sure.
All the time.
All the time.
Yes.
Okay.
So, wow, this has been so good. It's like, first of all, I feel like we have to have a certain mindset. We can't worry about what the market is doing all the time. Just leave it there and just dollar cost average, you know.
It. And you find your positioning. Remember, you can be conservative to moderate to aggressive, but you need to be in play. You need to be in play somewhere in there to win. And everybody's got some money, as I said, that they know they're not going to ever spend.
Yeah.
If you got money you're not going to ever spend, you should be investing that so you can grow it more for your next generation to have more.
Yeah.
Yeah.
Wow. Mm-hmm. This has been so good. So everybody who's listening, if you want some more information about anything you've heard tonight, please contact.
Next slide. There we go.
Royster at First Genesis of Virginia, and he will be happy to help you with any issue, any situation that you have. So we thank you so much. My name is Reverend Patricia Sims, coming from Mayfield Memorial Missionary Baptist Church, where my pastor is the Dr. Reverend Peter Wary. And so we just thank you for joining. We ask that you would like, share, and we hope to see you on the next seminar. It's going to be great, so we don't want you to miss it. Tell a friend and invite somebody to come along with you and get some knowledge. This is the time in this country that African Americans especially needs to be in the market. If the stock is going down, that's when we need to buy. Mm-hmm. And so, let's take some risks. You have to take risks in order to gain anything. So thank you all for watching, and we'll see you next time. God bless.
Have a happy and safe holiday.
Merry Christmas.
Merry Christmas. God bless you. Bye-bye.
Bye-bye.